Okay, let's just get right into it. Today we're doing a deep dive on the ARK Innovation ETF. Ticker ARKK. It's probably the most, I don't know, the most talked about, most polarizing fund on the market.
Oh, absolutely. And our mission today is really to just cut through all that hype.
Mm-hmm.
We want to look at the strategy and figure out what the performance data actually means for you.
And you have to start with the whiplash. The numbers are just wild.
They really are. I mean, think about this. If you got in early, $100 could have turned into over $400 during the pandemic.
But then, and this is the part that gets me, it lost 80% from that peak. 80.
Yeah, an 80% drop.
But here's the twist, right? Despite that, this year it's apparently roaring back. It's up over 50%. So what is this thing?
Well, it's Cathie Wood's flagship fund. The whole promise is pure exposure to what she calls disruptive innovation.
So we're talking AI, genomics, robotics, that kind of thing.
Exactly, and you're paying a premium for that vision.
Yeah.
The expense ratio is 75 basis points.
Which is, what, 10 times what you'd pay for a simple S&P index fund?
At least.
Yeah.
That fee is for active management.
Yeah.
It pays for them to go out and chase these moonshots.
And those moonshots seem to require some huge concentrated bets. This is what really makes ARKK different. It holds, what, only 48 stocks?
It's just 48. So when you look closer, Tesla alone is about 12% of the whole fund.
Wow.
And the top 10 holdings make up a whopping 56%. It is the exact opposite of diversification.
But that's why it works so well at first, right?
Precisely. When interest rates were basically zero, the market loved that. It loved these futuristic stories. So in 2020, ARKK returned 153%.
153. I mean, the S&P gained 40% that year, which was considered great. ARKK just blew it away. But then 2022 happened. What changed? Was it just the Fed?
It was a complete shift in the environment. The Federal Reserve started hiking rates and hiking them aggressively. And when rates go up, investors care a lot less about potential profits in 2030.
They want cash flow now, profitability now.
Yes. And that is a deadly environment for these kinds of high-growth stocks.
So the bottom fell out.
It cratered. The fund dropped 67% in 1 year.
67%. For context, the NASDAQ, which is already tech-heavy, dropped 33%. So ARK lost double.
And the math to recover from that is just brutal. After you lose 67%, you need a 203% gain just to get back to where you started.
Wow. That really puts it in perspective.
It does. For people who bought at the top, it's a very deep hole.
And you see these estimates from places like Morningstar. They figure ARKK has destroyed something like $12.3 billion in investor wealth since that peak in 2021.
It's a staggering number.
Yeah.
But, and this is the current twist, those same concentrated bets are working again. The fund is up over 50% this year because its big holdings like Tesla and Coinbase have surged.
So it's the same mechanism, just in reverse. Incredible leverage on the way up and on the way down. So if you put it all together, what's the final verdict here?
I'd say ARKK is basically a highly leveraged bet on speculative growth. Its volatility is double the market. And even with this year's big run-up, the 5-year return is still negative.
So it's really for a specific type of person.
It's for someone who truly believes that this kind of tech disruption will win out in the end, and they have the stomach to watch their account potentially drop 70% while they wait.
Right. And I guess that leaves you with the big question. This fund offers a path that passive funds just can't. But the real decision is whether you believe Cathie Wood's timing through all these violent cycles is better than yours. You're paying for her conviction, and you're hoping that conviction is eventually right.